Hey guys, welcome. Today we're going to be doing an analysis of the Disney stock. So ticker for this stock is DIS. It's traded on the New York Stock Exchange. Obviously we know Disney from the cartoons, the parks. Disney Plus is a new thing that's out. Let's start digging into the stock to find out a bit more information about it, and let's see how it's valued and how this opportunity may look for us moving forward. Okay, so a bit of basic info on Disney. So right now it's February 7th. The stock price is $142.70, has a market cap of $257.6 billion, and it has about 1.8 billion shares that are outstanding at this point in time. Looking into the valuation side of things, so as mentioned, we have a price of $142.70. So that translates into a PE ratio of 24.02. So from a value investing standpoint, that is a little bit high. Typically, we'd like to look for a PE ratio of around 15, which leads us to believe that based on the earnings that we have, that it is overvalued. Looking from an earnings per share perspective, we have $5.94 per share. So at a price of $142.70, it would give us a return of about 4.16% per year. Also, you have a dividend yield of around 1.35%. So in total, we could probably expect, just from the earnings per share and the dividend, around 5% for the stock. So not too bad. From a safety factor perspective, we want to dive into the price to book. So what we look at here is the book value or enterprise value of the stock and compare that to the price. So right now we see that the price to book is about 2.6. So what that tells us is, from a margin of safety perspective, the book value covers off about 38% of the price of the stock. So that is your safety. So in looking at this, again, the price to book to me at $142.70, that safety net is not great. I like to look at it at least about a 50%. But it isn't terrible in today's market. So that might be something to consider. So similarly to price to book, we'll look at debt to equity and debt to assets. So debt to equity right now is about 0.5, which is not bad, which means we have more equity than we do debt. So that's a good value. And debt to assets is 0.2. So from a debt perspective, not a ton of debt for this company. So that's a promising figure. From a return on equity perspective, it's about 12.4%, which is showing that the management efficiency is fairly good for this company. So we're sitting at a current ratio right now of about 0.89. From a value investing standpoint, we try to look for a current ratio of about 1.5. So this suggests that the ability for Disney to pay off its short-term liabilities is less than adequate at this point in time. If we look at the EV over EBITDA, so we're looking at a 14.3 right now, which is more than the 7.5 times that we typically see, or typically that we're looking for, but so it's suggesting that it might be slightly overpriced at this point. When looking at the Graham number, we're sitting at about 86.07. So in comparison to the stock price of 142, obviously the stock price greatly exceeds that. So let's take it down to the intrinsic value. So what we need to look out for the intrinsic value is, how are we trending from a cash flow and a net income perspective? So looking at the graph for free cash flow here, we see that it's generally trending pretty well. Unfortunately, in 2019, it takes a bit of a dip. So we're going to need to look into, why did it take that dip in 2019 and what's the rationale for that? From an enterprise value perspective, we see it actually takes a bit of an increase in 2019. So that may give us some clues as to what happened for the free cash flow. So perhaps something was acquired in 2019 that hurt cash flow but helped our overall enterprise value. Looking at revenue, excellent agreement with the linear trend here. Really good, strong revenue growth year over year for the past 10 years. So that's something that is definitely encouraging. Net income, again, follows a good straight line here. So, we have a pretty good story to tell from a net income and a revenue trend perspective. So I'm going to look at the net income specifically when I'm coming up with a growth calculation for Disney. Great R squared value. We have about 0.93, so it suggests it follows that linear trend nicely. So we're going to use that over the cycle here. So in looking at that, so I'm going to come up with a net income growth rate here, and I came up with a number of 12%. So I'm going to discount the cash flow by 8.1%, and I'm going to use a terminal value of 2%, because in looking at the 10-year Treasury, I think we're sitting at about 2.5% right now. So I could use 2%, I could use 3%, and look at the comparisons there and see what happens. So in doing the intrinsic value calculation, what we want to do is look at the last year's cash flow and use that to try to discount it based on growth. The problem that we have with Disney here is we've taken a big dip from a cash flow perspective. So that is something that we need to monitor. That could actually hurt the intrinsic value calculation quite a bit. So what I'm going to propose to do is use the 2018 number, because if I use the 2019 number, their free cash flow went down by about 89%, is what they said in their annual report. So I think that's probably too much. We're going to look into why that went down. So I'm going to focus in on the 2018 future cash flow free cash flow, and I'm going to use that to calculate my future cash flow. So in using the 2018 free cash flow, the intrinsic value I get for this stock is upwards of about $195, $197 per share. Now, if I end up using and this is where it becomes a bit tricky, if I end up using the 2019 cash flow number, that reduces dramatically, and now the intrinsic value I'm looking at is about $22 per share. So I'm seeing some really large differences between there. So that's something I'm going to have to monitor if I'm investing in Disney. I want to monitor that free cash flow. I'm going to take a look at how that compares for the quarterly statements when they're coming out, and see really why is it that we're seeing this difference. Okay, so let's do a bit of a deeper dive. Let's try to look at their annual report here. We'll take a look at the summary and see if we can't figure out why we are seeing such a dip in free cash flow, and is this something that could be problematic for us in the future. So one of the most important things to do when looking into investing is to check the quarterly and annual reports. So if I look at the annual report, what I see is a strong continued investment in streaming services. So I think the latest one that everybody's aware of is Disney Plus. There's ESPN Plus and investments in Hulu, so they have a controlling share in Hulu. So this is something that's really where Disney's focused on for the future, and they're investing a lot of money here. So one thing that we look into what happened in 2019, if we look at the acquisitions, we see that they acquired Fox's entertainment assets, which would help for their streaming services, in a $71 billion deal. So when we look at the hit that we took in cash flow, a large portion of that is probably tied up in the entertainment assets that they acquired from Fox. So hopefully we'll see in future quarters that there will be some benefits here in the streaming services, and that will translate into strong earnings. Again, the return on equity is very strong for Disney. We're looking at about 12%. So as they increase their investments into Fox's entertainment assets, we hope to see good earnings from that in future quarters. So on the positive side, Disney's media networks reported revenue of $6.7 billion, which was on the rise from previous, and Parks also posted a rise in revenue when in comparison with previous quarters. So right now, the direct-to-consumer segment, so this is looking at the streaming services, saw a revenue of $3.86 billion in comparison to for that period, with operating losses increasing to $553 million from $168 million. So this is a focus on the future for them. A lot of investments into Disney Plus, and hopefully we'll see that these operating losses will not exist in the direct-to-consumer segments, and that becomes a source of earnings for them for the future. So one exciting thing for direct-to-consumers is the bundling of services. So Disney Plus, ESPN Plus, and Hulu subscriptions for $12.99 per month to rival what Netflix is charging in their subscription plans. And the bundle was launched alongside Disney Plus, so that's something to look forward to for earnings. And we have seen that there's quite a rise in Disney Plus membership at this point in time. So one of the things for the Fox Entertainment investments, there are titles that they have through the entertainment asset acquisition, things like Home Alone, Night at the Museum, Cheaper by the Dozen, Diary of a Wimpy Kid, which is really popular with my kids, and showing content on Disney Plus. So that is hopeful to attract new customers and viewers to that network. So as we're looking through the annual reports or quarterly reports, what we see is really a lot of strong content. The Marvel movies set records in 2019. ESPN and NBA had record earnings for TV. It was up, I believe, 24% for the year. So really a lot of potential in the viewership area and the content that they create and have available. So that's something that we'll be looking for in quarterly reports for 2020. So a lot of potential here, a lot of content that could be escalated in the future. Really, a promising future, I think, for Disney. So in summary, when we're looking at this, excellent trends from revenue and net income. Enterprise value is going up. Free cash flow appears to be a bit of a problem, but that would likely recover. So I think that where we could be headed with the Disney stock price when looking at the intrinsic value is upwards of $200 per share. So based on that and just looking at the earnings per share and dividend yield, hopefully getting a minimum of 5% on my investment, I'm excited to have Disney as part of my portfolio. Something I want to be monitoring, though, just to make sure it doesn't inflate too much. From a price perspective. From a safety point of view, I see that the price to book is a little bit low, but Disney is a brand that I think won't take too much of a hit, so I don't too concerned for a large cap stock like this that I have to worry about it potentially filing for bankruptcy. So that's my review of Disney. I hope you guys enjoyed this review. We'll be doing stock reviews on a weekly basis and looking at the valuations of them. And really, really appreciate you guys tuning into this episode. We'll catch you next week.